Hey guys, welcome back. We are continuing on with Chapter 3 of The Deficit Myth by Dr. Stephanie Kelton. I hope you guys enjoyed the last one. I certainly did. Always feel free to let me know what your thoughts are down below about the book, or maybe any thoughts, regarding modern monetary theory, or if you guys have any curiosity into, stuff like this, let me know, and I can definitely hook you up with any of that, or just have a conversation. Other than that, let's get back into Chapter 3. Still, isn't there some limit? As Isaac Newton taught us, quote, what goes up must come down. Surely the debt can't go on rising forever. If the government never pays us down, then it has to keep funding new buyers for its bonds. It seems risky. As Margaret Thatcher famously quipped, the problem is that, quote, eventually you'll run out of other people's money. To some people, finding new investors to purchase a never-ending mountain of government debt can start to look like a fraudulent pyramid scheme, the kind run by the notorious huckster Bernie Madoff. It isn't. Madoff was defrauding investors. The United States Treasury is not. As Alan Greenspan explained in an appearance on NBC's Meet the Press, investors face, quote, zero probability of default. When it comes to U.S. Treasuries, and here we should distinguish between voluntary and involuntary default, Greenspan's statement referred to the latter. His point was that the U.S. cannot end up like Greece, desiring to make scheduled payments to bondholders but lacking the authority to instruct its central bank to clear the payments. Congress to do something stupid, like refusing to raise the debt ceiling limit, which might trigger a voluntary default. But there is zero risk of the U.S. being forced into default by its creditors. That's because the federal government can always meet its obligation to turn those yellow dollars back into green dollars. All it has to do is change the relevant numbers on the Federal Reserve's balance sheet. There's also no risk of running out of, quote, other people's money. Remember, Thatcher had it backward. Her model treated the British government like a household that had no alternative but to collect taxes or borrow other people's money to pay the bills. Now, real quick, like what she said earlier in the book here about Bernie Madoff, for those who know he is, I'm glad you do, but for those who don't, Bernie Madoff was a guy who defrauded very wealthy people, and that's what got him in trouble. So if you're someone who runs a company, or and you're ripping people off, you're defrauding on loans or other shit, you're going to be fine. But once you start doing that to wealthy people or those in the government, then you're probably going to end up in prison. So that's what happened to Bernie Madoff. MMT flips this around, showing that the more appropriate real-world sequencing is STAB. The government spends first, making dollars available to pay taxes or purchase government bonds. Take an example. Suppose S, spending, equals $100, meaning that the government spends $100 into the economy. Now suppose that the government taxes 90 away from us, meaning the government's deficit has left us with $10 to hold on to. Currently, the government coordinates any deficit spending by selling an equivalent amount of securities, that is, borrowing. The important point is that the $10 that is needed to buy the bonds has been supplied by the government's own deficit spending. In that sense, the currency issuer spending is self-financing. It's not selling bonds because it needs the dollars. Bond sales just allow holders of reserve balances, green dollars, to trade them in for U.S. Treasuries, yellow dollars. It's done to support interest rates, not to fund the government. So since our lawmakers have not yet had the benefit of seeing MMT's insights, they view debt service as a growing financial burden on the federal government. That's a mistake. In truth, paying interest on government bonds is no more difficult than processing any other payment. To pay the interest, the Federal Reserve simply credits the appropriate bank account. Right now, Congress looks at the federal budget as a zero-sum game. Lawmakers look at rising interest expenditure the way we might look at a rising cable bill. It means less money to spend on everything else. So when the CBO says that the federal government is on track to, quote, spend more on interest payments than the entire discretionary budget, which includes deficit, defense, and all domestic programs by 2046. Many lawmakers begin to panic. They think it shrinks the amount of money that's left over. The congressional budget is limited only by Congress. To avoid cutting back on programs its people value, Congress can simply authorize a larger budget to fund its other priorities. There's no fixed pot of money. There is, however, only so much room in the economy to safely absorb higher spending. That's the constraint Congress needs to worry about. The limit, as we saw in Chapter 2, is our economy's capacity to absorb that additional spending without pushing inflationary high. Every dollar that is paid in the form of interest becomes income to bondholders. If those interest payments become too large, the risk is that the total spending could push the economy above its speed limit. MMT has emphasized that rising interest income can serve as a potential form of fiscal stimulus. The federal government is a net payer of interest, and all of the interest it pays out is received by holders of government securities. At least some of the interest income goes to the people who turn around and spend it back into the economy, buy newly produced goods and services. If a high percentage of interest income was spent back into the economy, it could potentially push aggregate spending above potential, fueling some inflationary pressure, though, as Vice President Joe Biden's former chief economist, Jared Bernstein, notes, it seems unlikely that the government's interest payments will fuel overheating anytime soon. In part because, quote, above 40% of our public debt is now held by foreigners, which means, quote, an increased share of interest payments now leak out of the country. Even if bondholders aren't even spending enough of their interest income to fuel ordinary price inflation, like the CPI, they might still fuel asset price inflation by using their interest of income to bid up the prices of commodities, real estate, stocks, and so on. There's the potential for inflation, and there are distributional implications involved. But paying interest on government securities poses no financial challenge for the federal government. Some people complain that the government shouldn't be spending and paying interest at all. They see treasuries as a kind of luxury good, something that is only available to people who already have a lot of money. By turning their green dollars into yellow dollars, the government ends up adding to their riches over time, potentially widening the gap between those at the bottom and those at the top of the income distribution. That's one way to look at it. Of course, treasuries are also safe assets that help diversify asset risk. So they provide a layer of protection to many working class people who have pensions or other kinds of retirement plans that invest some of their money into government bonds. Distributional issues aside, Uncle Sam can always handle the interest payments. We could pay it off tomorrow. In April 2016, Time magazine devoted its cover to the U.S. national debt. It began, quote, "Dear reader, you owe $42,988.12. That's it." The cover continued. "Whatever American man, woman, and child would need to pay the erase the 13.9 trillion U.S. debt. I don't know about you, but I don't have $43,000 lying around. I'm also not squirreling away money in anticipation of one day being asked to write Uncle Sam a big fat check for, quote, my share of the national debt. It's never going to happen. The idea that the rest of us are personally liable for some portion of the national debt is preposterous. It's an extension of those household budgeting philosophy that wrongly assumes that the government must ultimately depend on us, the taxpayer, to pay its bills. I hope it's clear by now why that logic makes no sense and why it's applied to a currency issuing government. Because the truth is, the entire national debt could be paid off tomorrow, and none of us would have to chip in a dime. That's not how most economists see it. Some will argue that the faster growth would help us deal with our, quote, debt problem, because it's the ratio of debt relative to the size of our economy. Debt versus GDP. That really matters. The numerator, the debt, is rising, but the ratio will fall if the denominator, economy, grows faster than the debt. For many economists, that's the right way to look at the problem. The trick, then, is to keep the debt ratio from heading northward and perpetuity. At some point, it must come down, or the debt path is considered mathematically unsustainable. For decades, conventional thinking held that the U.S. debt was on an unsustainable path because the formal models used to evaluate the debt trajectory all showed the ratio rising steadily, higher into the indefinite future. Today, some of the most influential economists in the world are telling us that the debt might be sustainable after all, at least for now. These mainstream economists don't arrive at the paradigm-shifting conclusions of MMT economists, but some of them have softened their rhetoric in ways that have tempered anxieties about a looming debt crisis. For example, in January 2019, Oliver Blanchard, world-renowned economist and former head of the International Monetary Fund, IMF, made this the focus of his presidential address at the annual meeting of the American Economic Association. In that speech, Blanchard explained that the debt trajectories for many countries, including the United States, appear to be on a sustainable path, at least in the near term. That's because Blanchard expects the future to look a lot like the recent past, which is to say he expects interest on the debt, R, to remain below the economy's growth, G, a condition, R, less than G. That ensures that the debt ratio will not head off to infinity. If he's right, then his model predicts that the U.S. will not experience a debt crisis anytime soon. But Blanchard does not dismiss the possibility of a future crisis. For him, we're safe until one day in the future when financial markets push the interest rate above our economy's growth rate, R over G. When that day arrives, we're right back on an unsustainable debt trajectory, unless a budget has moved into surplus in the interim. Until then, we can relax and perhaps even safely increase the size of the fiscal deficit. Because Blanchard's findings ran so counter to the dominant, media and political, narrative about public debt, his findings received significant media attention within days of his speech. Market Watcher in an article featuring the headline, quote, "Leading economist says high public debt might not be so bad." Shortly thereafter, the Wall Street Journal asked, quote, "Worry about debt? Not so fast. Some economists say." These were important findings, but it should be pointed out that MMT economist Scott Fulwiler made a similar observation 13 years earlier. The difference between Fulwiler's early work and Blanchard's more recent study is that Fulwiler looks at the question of debt sustainability through the MMT lens. Unlike Blanchard, he recognizes that a government that borrows in its own sovereign currency can always maintain the critical condition for sustainability, R less than G. It never has to accept a market rate of interest. For Fulwiler, Blanchard's, quote, "concept of fiscal sustainability is flawed due to its assumption that a key variable, the interest rate paid on the national debt, is set in financial markets." In other words, Blanchard's more cautious take on sustainability rests on the possibility that interest rates could eventually jump higher, leading on to the kind of debt crisis that unfolded in Greece or Argentina. But the U.S. is not like Greece, which borrows in euros, or Argentina, which defaulted on U.S. dollar-denominated debt. It can't lose control of its interest rate. As Fulwiler observed, interest on the national debt is, quote, "a matter of political economy," meaning that policymakers can always overrule market sentiment. Or, as James Galbraith humorously put it, quote, "It's the interest rate, stupid." To prevent interest on the debt from rising above the economy's growth rate, Galbraith simply advised the central bank to, quote, "keep the projected interest rate down." It's a critically important insight that distinguishes the MMT perspective on debt sustainability from more conventional thinking. Under MMT, it's an inflation, not the relationship between interest rates and growth rates, that matters. Still, it's easy enough for the U.S. and other monetary sovereigns to satisfy the conventional criteria for sustainability. Just look at Japan. At 240%, Japan's debt to GDP ratio is the highest in the developed world. At the end of September 2019, Japan's national debt had a record of $1,335,550,000,000. That's more than a million billion. Imagine the horror Senator Enzi would experience at the thought of more than a quadrillion in debt. That's a lot of zeros. If it was featured in Time magazine, the cover would read, quote, "You owe $10.5 million, about $96,000 per person in US dollar terms. But Japan, like the US, is fine. at least when it comes to stat sustainability, because it's a currency issuing government with a central bank that can clear every payment obligation that it comes due. Financial markets can't push Japan into crisis because the Bank of Japan, BOJ, can override any unwanted move in interest rates. It could also essentially retire the entire debt using nothing more than a computer keyboard at the Japanese central bank. Most of the world's leading central banks focus on setting just one interest rate, a very short interest rate known as the overnight rate. They rigidly fix this rate and then allow longer-term rates to reflect market sentiment about the expected future path of the short-term policy rate. That means that the interest rate that's paid on longer-term government bonds is related to the overnight rate that its own central bank is setting. As Fulwiler put it, quote, "This means that longer-term rates are based upon current and expected actions of the central bank. That leaves investors with some influence over the interest rate that the US government pays on treasuries, or the British government pays on gilts." In the UK, government securities are known as gilt-edge bonds, or gilts for short. But, and this is really important, the government can always strip markets of any influence over the interest rate on government bonds. Indeed, that's exactly what the Federal Reserve did during and immediately after World War II, and it's what the Bank of Japan is doing today. To keep a lid on interest rates during World War II, the Federal Reserve, quote, "formally committed to maintaining a low interest rate peg of 3/8%, one on short-term treasury bills, and, quote, also implicitly capped the rate on long-term treasury bonds at 2.5%. Even as deficits exploded and the national debt climbed from $79 billion in 1942 to $260 billion by the time the war ended in 1945, the federal government paid just about 2.5% interest on long-term bonds. To hold rates at 2.5%, the Fed simply had to buy large quantities of U.S. Treasuries. It required an open-ended commitment on the part of the Fed, but it was an easy commitment to fulfill, since the Fed purchases bonds, yellow dollars, simply by creating the seller's account with reserves, green dollars. Even after the war ended, the Fed continued to anchor the long-term interest rates on behalf of the government. Coordination with fiscal policy eventually ended in 1951, with an agreement known as the Treasury Federal Reserve Accord, which freed the Fed to pursue independent monetary policy. Elsewhere, central banks are returning to explicit coordination of fiscal and monetary policy. For more than 3 years, the BOJ has engaged in a policy known as yield curve control. In addition to anchoring the short-term interest rate, the BOJ committed to pinning rates on 10-year government bonds, known as Japanese government bonds, or JGBs, near zero. And carrying out that policy, the BOJ has purchased massive amounts of government debt, buying up $6.9 trillion. In June 2019, as a result of its aggressive bond buying program, the BOJ now holds roughly 50% of all Japanese government bonds. So while Japan is often described as the most indebted developed country in the world, half of its debts has already been essentially retired, i.e. paid off, by its central bank, and it could easily go all the way to 100%. If it did, Japan would become the least indebted developed country in the world, overnight. MMT economists understand this, but not many others seem to realize how easy it would be for a country like Japan, or other countries from sovereigns, to pay off the entire public debt. It could also be done tomorrow without collecting a penny from taxpayers. One of the few people who appears to understand this is an economist, Eric Lonergan. In 2012, he published a thought experiment asking, quote, "Would Japan monetize 100% of outstanding JBGs?" It was a fancy way of asking what would happen if the central bank retired the national debt. How? The same way the BOJ got the bonds it already holds, namely by crediting the seller's bank accounts. It's a thought experiment, so Lonergan imagines the BOJ doing this with a one-time flick of the wand. Quote, "Let's assume the BOJ comes out tomorrow and purchases the entire stock of JGBs by creating bank reserves, money, and cancels the debt. Proof, the debt is gone." Lonergan then asks, quote, "What would happen to inflation growth in the currency?" In his view, nothing would change if you had 100% monetization of the stock of JGBs. To some, this might seem preposterous. How can the BOJ manufacture $500 trillion out of thin air without devastating inflationary consequences? Most economists are trained to accept some version of the quantity theory of money, QTM, Strict adherents to the theory, such as followers of Milton Friedman, will likely scream, quote, Zimbabwe, Weimar, or Venezuela. That's because the QTM teaches that, quote, inflation is always and everywhere a monetary phenomenon. The idea of conjuring a $500 trillion of new cash to buy a government debt causes them to immediately anticipate hyperinflation. Lonergan, who works in financial markets, knows better. He correctly observes that swapping JGBs for cash has no effect on the private sector's wealth. Instead of holding government bonds, investors now, quote, hold the same value in cash. While net wealth is unaffected, buying up JGBs does have an effect on income. That's because the bonds are interest-bearing instruments, and the cash is not. When the BOJ replaces bonds with cash, the private sector loses out on any interest that would have been paid. So retiring the debt siphons interest income out of the private sector. With this in mind, Lauren again asks, quote, why on earth would the Japanese household sector rush out and buy things when their income has fallen? Their wealth is unchanged, and they are used to paying and used to falling prices. The short is, they wouldn't. If anything, transferring all of that outstanding government debt onto the central bank's balance sheet would tend to push prices lower, not higher. I would think twice about stripping the private sector of all of its interest-bearing government bonds at once. But the Japanese government could certainly pull it off. The U.S. could do it too. A life without debt? Just think of it. No more government shutdowns as lawmakers engage in theatrical uprisings over raising the debt ceiling limit. No one comparing Uncle Sam to a spendthrift who's running up the credit card and borrowing from China. No fear of losing access to the bond market and being forced into default like Trace. No economists arguing about whether interest rates will be low enough to keep the debt on a sustainable path. And best of all, no more stress about how to cover, quote, your share of the national debt. We could rip the bumper sticker right off. We actually did it once. It was in 1835. Andrew Jackson was president, and it was the only time in U.S. history when the public debt was paid all the way down. That was long before the Federal Reserve was created, so that the debt wasn't gobbled out of existence by the central bank. Instead, it was limited by the old-fashioned way. That is, by reserving fiscal deficits and paying off bondholders. It didn't end so well. It took more than a decade to retire the entire debt. It happened because the government ran fiscal surpluses from 1923 to 1936. It was taxing away more money than it was spending in each of these years. It didn't issue new debt. Instead, as bonds matured, the government simply paid them off. By 1835, the U.S. was debt-free. It was also headed for one of the worst economic downturns the country has ever experienced. In hindsight, it seems obvious why things unfolded the way they did. Fiscal surpluses suck out money of the economy. Fiscal deficits do the opposite. As long as they're not excessive, deficits can help to maintain a good economy by supporting incomes, sales, and profits. They're not imperative, but if they disappear for too long, eventually the economy hits a wall. As Frederick Thayer, the prolific writer and professor of public international affairs at the University of Pittsburgh, wrote in 1996, quote, the U.S. has experienced 6 significant economic depressions, and quote, each was preceded by a sustained period of budget balancing. So just from fun details for you guys, a little chart here kind of breaks it down for you. So, this box says, years when debt was paid down, 1917 to 1921. The percent decline in debt was 29%. Year depression began 1819. The next dates were 1823 to 1836. 100% decline in debt. Year depression began 1837. The next set of dates, 1852 to 1857. Percent decline in debt, 59%. The year depression began 1857. 1867 to 73. The percent decline in debt, 27%. The year depression began 1873. And then 1880 to 1893. Percent decline in debt, 57%. The year depression began 1893. And lastly, 1920 to 1930. The percent decline in debt, 36%. Year depression began 1929. So I'm sure you guys can see a pattern of every time they try to do the debt payoffs or deficit payoffs the wrong way, we ended up in a depression. So the historical record is clear. Each and every time the government sustainably reduced the national debt, the economy fell into depression. Could it have been a remarkable coincidence? They didn't think so. He blamed the, quote, economic myths that drove politicians to wrestle their budgets into surpluses on the flawed belief that paying down debt was both morally and fiscally responsible. As we see from the insights of MMT, government surpluses shift deficits onto the non-government sector. The problem is that the currency users can't sustain those deficits indefinitely. Eventually, the private sector reaches the point where it can't handle the debt it's accumulated. When that happens, spending grinds sharply lower and the economy falls into depression. Since Thayer's work was published, the U.S. experienced one other brief period, 1998 to 2001, of sustained fiscal surpluses. It happened during the Bill Clinton's presidency, and many Democrats still look back on it as a crowning achievement. The red ink was eliminated, and Uncle Sam was back in the black for the first time in decades. The surplus began in 1998, and by 1999, the White House was ready to party like it was, well, 1999. The following year, White House economists began working on a report titled, quote, Life After Debt. It was supposed to deliver the celebratory news that the United States was on track to retire the entire national debt by 2012. At first, paying off the debt seemed like the kind of accomplishment that might be worthy of a national parade. The White House prepared to feature the news in its annual economic report of the president, but then everyone got cold feet, and the chapter of the report was hidden from the public view. We only knew about it because National Public Radio's Planet Money obtained a secret government report outlining what once looked like a potential crisis, the possibility that the U.S. government might pay off its entire debt. Instead of shouting it from the rooftops, White House officials quietly tucked it away. The reason? They were worried about the broad implications of wiping out the entire U.S. Treasury market. It was a return to the love-hate relationship many public officials have with their national debt. On the one hand, the White House would have loved to eliminate the national debt. On the other hand, it couldn't risk getting rid of all treasuries. What worried policymakers the most was the prospect of depriving the Federal Reserve of the key instrument it relied on to conduct monetary policy, government debt. At that time, the Fed was relying on government bonds to manage the short-term interest rate. When the Fed wanted to raise interest rates, it sold some of its treasuries. Buyers paid for those using a portion of their banking reserves. By removing enough reserves, the Fed can move the interest rate up. To cut rates, the Fed would do the opposite, buying treasuries and paying for them with newly created reserves. Without treasuries, the Fed would need to find some other way to set interest rates. In the end, the problem would solve itself. By 2002, their surpluses were gone, and the U.S. is no longer on track to pay down the national debt, much less retire the full amount. The federal budget moved back into deficit after 2001, when the stock market bubble, which had been supporting consumer spending, burst. A recession began in 2001. It was a fairly mild recession, but the damage has been done. And we'll see in the next chapter, the Clinton surpluses had weakened private sector balance sheets, magnifying the damage caused by the arrival of the Great Recession, which began in 2007. The Great Recession changed the way the Federal Reserve conducts monetary policy. In November 2008, the Fed launched the first of 3 rounds of a massive bond buying program called Quantitative Easing. Among other things, the Fed hoped its program would help stimulate the U.S. economy by lowering long-term interest rates. By the time it was over, the Fed had gobbled up $4.5 trillion in bonds, including nearly $3 trillion in U.S. Treasuries. In addition to using quantitative easing to push long-term interest rates lower, the Fed also changed the way it managed its short-term interest rate. Instead of buying and selling treasuries to add and subtract reserves, the Fed switched to a, quote, more direct and more efficient method of interest rate support. It simply started paying interest rates on reserves balances. Today, the Fed can adjust the short-term interest rate at any time it chooses, simply by announcing that it will pay a new rate. What this means is that the times have changed. The dollar is no longer tied to gold. The U.S. issues a freely floating fiat currency, so it doesn't need to tax or borrow before it can spend. Indeed, as we learned in Chapter 1, the STAB model reflects the way the economy actually works. Taxes aren't important because they help the government pay the bills. They're important because they help to prevent government spending from creating an inflation problem. Similarly, bond sales aren't important because they allow the governments to finance fiscal debts. They're important because they drain off excess reserves, which enables the Fed to hit a positive interest rate target. But today the Fed pays interest on reserve balances, so it no longer relies on the treasuries to hit its right target. So why keep them around? Should we love them or leave them? Is the national debt a, quote, national treasure, as Alexander Hamilton believed? Or is it, quote, irresponsible and patriotic, as Barack Obama described it? Should we trash it or treasure it? One thing is for sure. We don't want to start wiping out U.S. Treasuries the ugly way, the 1835 way, the Clinton way, by building fiscal surpluses on the back of unsustainable private sector deficits. As we'll see in the next chapter, that has predictably negative consequences for our economy. If we really want to make the national debt disappear, there are more painless ways to go about it. The most straightforward option is to do it in the way Lonergan described. Simply let the central bank buy up government bonds in exchange for bank reserves. A pain-free transaction that turns yellow dollars back into green dollars. It can be carried out using nothing more than a keyboard at the Federal Reserve. Another option would be plays out the issuance of treasuries over time. Instead of selling bonds to drain off the reserve balance sheets that result from deficit spending, we could just leave the reserves in the system. We can do it without interfering with the Federal Reserve's ability to conduct monetary policy, because the Fed doesn't need government bonds to hit its short-term interest rate or target. Over time, all the outstanding bonds will mature, and the debt will gradually disappear. There's another option. We could learn to live with them. There is nothing inherently dangerous about offering a safe, interest-bearing way for people to hold on to dollars. If we choose to live with them, should come to grips with the fact that the thing we all call the national debt is nothing more than a footprint from the past. It tells us where we've been, not where we're going. It records a history of the many deficits that have been run since the birth of our government in 1789. The bloody world wars, our many recessions, and the decisions taken of the thousands of people elected to Congress over the years. What matters is not the size of the so-called debt, or who holds it, but whether we can look back with pride, knowing that our stockpile of treasuries exists because of the many, mostly, positive intervention that were taken on behalf of our democracy. If we're not going to eliminate treasuries, then we must find a way to make peace with the national debt. Perhaps we should start by giving it another name. The national debt is nothing like household debt, so using the word debt just leads to the confusion unnecessary angle. We could just refer to it as a part of our net money and supply. I doubt yellow dollars will catch on, but hey, is it worth a shot? In Shakespeare's Romeo and Juliet, Juliet famously inquires, quote, "What's in a name?" She wasn't troubled then when she learned that Romeo was a Montague. For her, quote, "A rose by any other name would smell just as sweet." Love, as they say, is blind on the political stage. Words matter. It's time to come up with a new name for these interest-bearing dollars. All right. Chapter 4. Their red ink is our black ink. Myth number 4. Government deficits crowd out private investment, making us poor. Reality. Fiscal deficits increase our wealth and collective savings. So most of the time, we're bombarded with fairly simple deficit myths. We're told to think of the federal government like a household. Chapter 1. That is recklessly overspending. Chapter 2. And running up the national credit card. Chapter 3. These myths are built for mass consumption. They make great sound bites on television and in political stunt speeches because they're so easy to articulate. You don't need a background in economics or anything else to quickly absorb the message. Other myths are harder to package for effective messaging because they're rooted in the jargon of mainstream economics and mainly espoused by academics and so-called policy wonks. We may not encounter them as frequently, but that does not make them any less dangerous. The quintessential example of this kind of myth is known as crowding out. In its most common form, the crowding out myth says that the fiscal deficits require government borrowing, which forces Uncle Sam into competition with other would-be borrowers. As everyone competes for an unlimited supply of available savings, borrowing costs more higher. With interest rates on the rise, certain borrowers, especially private businesses, won't be able to secure funding for their projects. This causes private investment to fall, leading to a future where there are fewer factories, machines, and so on. With a smaller stock of capital goods, society ends up with a less productive workforce, slower wage growth, and a less prosperous economy. It does sound ominous. It's a complex narrative that rests on a number of theoretical propositions. If you've encountered it all, it was probably on C-SPAN rather than Fox News or MSNBC. Even those of us who follow politics fairly close might go a lifetime without hearing someone carefully articulate the crowding out story, but in Washington, D.C., it's everywhere. It appears as boilerplate in the CBO's Long-Term Budget Office Outlook, one of the most widely anticipated budget reports to come out each year. Pick up virtually any edition, and you'll find a section outlining the crowding out thesis. The 2019 report described the supposed risk of fiscal deficits this way. Quote, the projected path of federal borrowing would reduce output in the long run. When the government borrows, it borrows from people and businesses whose savings would otherwise finance public investment, private investment, and productive capital, such as factories and computers. A professional class of budget wonks, academics, and Washington insiders treat it as an article of faith. Technical jargon and a heavy smattering of charts and data give the narrative as an impressive veneer of credibility that can leave readers with the impression that crowding out is something that happens, in a mechanical and inevitable way, much like a mathematical series of rigorously tested if-then statements. If deficits require more borrowing, then the supply of savings available to finance private investments is reduced. If the supply of savings is reduced, then interest rates will rise. If interest rates rise, then private investment will decline. If private investment declines, then the economy will grow more slowly over time. Tap the first domino, and the rest obediently give way. The whole story is rooted in a version of mainstream economists that dominates our political discourse. You hear it from liberal icons like the New York Times' Paul Krugman, as well as conservative commentators like the Washington Post's George Will. And if you do happen to watch C-SPAN, you might have heard of someone like Jason Furman, a Harvard-trained economist who worked in the Obama White House as a chair of the Council of Economic Advisors, invoking in its testimony before Congress. For example, on January 31st, 2007, he appeared before the U.S. Senate Budget Committee, urging members of Congress to, quote, stem the flow of red ink. He described the budget outlook as, quote, a major fiscal challenge that, quote, drives down national savings. He warned that the chain reaction events that would ultimately jeopardize our economic well-being would be, quote, slow and gradual but relentless and inevitable. Crowding out a story that depicts government deficits as the villains of progress. Saving is considered an act of virtue because it is believed to supply the fuel that is used to fund the kinds of private sector investments that make us a wealthier society. Deficits are said to undermine the prosperity by siphoning away some of the fuel for its own use. Fiscal deficits and private investments are therefore considered to be in tension with each other, as government borrowing increasingly leaves behind a smaller pool of savings to support the needs of private industry. This is the conventional wisdom among mainstream economists, and may appear straightforward and compelling, but it is best thought of as a series of domino-linked myths. Alright guys, I'm going to go ahead and end this one here. I appreciate you guys watching. Hope you enjoyed and maybe learned a thing or two that sounded interesting to you. Let me know what you guys thought, and have a great day.